Return of capital, if you're an income investor, is one of the most controversial topics you're going to be encountering in your journey. And there are two camps when it comes to ROC, and I'm going to discuss them both because technically they're both correct to some degree. And one camp believes that ROC, return of capital, is really bad because you're getting back your own money, and the other views ROC as tax advantageous. So I'm going to talk about both of them so that hopefully by the end of the video, you're going to be clear as to which camp makes the most sense for you to stand by. And I'm going to give you my personal opinion as to which one it should be, and also dispel some of the myths regarding return of capital, because there's a lot of misdirection in some of the YouTube videos that I've seen out there. And I'm going to pull some of the ROC actual examples from funds. Not that I'm going to talk about funds specifically in this video, but simply as a way to put it in perspective and help you understand ROC. Before we get started though, I do want to put this in context for you. If you're new to the channel, I wanted to welcome you. My focus is strictly covered call ETFs and income ETFs. That is a passion of mine. And I do have a background in the hedge fund industry, specifically investment research, along with an engineering degree. So that gives me, I believe, a pretty mechanical perspective in terms of how the funds are actually constructed. Now, having said this, I do want to put out a disclaimer that nothing in this video is meant as financial or tax advice, and I highly recommend you talk to a financial professional and also a tax professional before you make any investment decisions. Also, please note that past results are not going to be indicative of future ones. So first, let's talk about what return of capital really is, because there's a lot of misconceptions that it's always inherently bad. And there's a lot of conservative investors and even fund managers, professional fund managers, that think it's inherently bad. And that's not always the case. There is good ROC and then there's destructive ROC. But in its purest form, ROC is a tax classification. It's not a distribution. It's a way for you to defer your taxes by reducing your cost basis. As long as your asset doesn't erode, and I'm going to go into what that means in a little bit, it's actually a very efficient way to tax defer and build up toward almost playing with house money. And that's what a lot of high yield income ETF investors actually seek. Let me give you an analogy. Let's say that you give somebody a whole block of ice, and in the course of the year, that person gives you back a tiny block of ice back. But at the end of the year, you have 4 blocks of ice that equal the same volume as that big block of ice that you had given him. That's what return of capital is in its purest form if you would get 100% ROC. The other example would be if you had given a block of ice, and while they're chopping up that block of ice and giving you back a smaller piece, it's melting so that what you get back at the end of the year is actually less volume than that original block of ice. That's what's called destructive ROC, and that often stems from NAV erosion. I'm not going to go into what that means here in depth right now, but basically you're going to be ending up with a lot less capital than what you had originally invested into the fund. And when they make it sound like these are pretty attractive distributions, it can be where it's destructive because of NAV erosion. I'm going to put a link to a video that talks about it at the end of this one. But let's go into an actual example. Imagine we have 2 funds, Fund A and Fund B. You buy one share each for $20, and both funds are going to pay you a $20 distribution. So at first glance, that sounds exactly the same, correct? But not for taxes, because Fund A is going to pay you $20 of return of capital at 100%. Basically, the IRS is saying, okay, that's your own investment coming back to you. So you don't have to pay tax on that $20 right now. But there's the catch. You originally paid $20 for the investment, so your cost basis was $20. And after receiving $20 of return of capital, your cost basis drops to zero. And if you sell later for $20, assuming it remained the same price, you sold something for $20 that has zero cost basis. So you've got a $20 capital gain. So you didn't avoid the tax, you deferred it. Now, looking at Fund B, you also pay $20 for Fund B, but Fund B gives you $20 taxable distribution instead of return of capital. So you would owe taxes on that $20 right now. But your cost basis stays above $20. So if you later sell Fund B for $20, you bought it for $20 and sold it for $20, the capital gain would be zero. And that's the big idea. So Fund A is no tax on the $20 return of capital right now, but your basis drops to zero, potentially creating a capital gain later if you decide to sell it. Fund B, you pay tax on the $20 distribution now, yet your $20 cost basis is going to remain. So when you hear return of capital, don't think it's tax-free. It's more tax-deferred. The tax is going to be getting pushed down the road, but that tax deferral can be valuable, especially if you're holding the investment for a long time. And that's where a lot of high distribution income ETF investors want to get to. And that's when I say house money. That's essentially where they want to be. They want to get to the cost basis being zero. One thing I did want to specify as well, the cost basis cannot be negative. So if you receive additional return of capital for Fund A that exceeds $20, you would have to pay taxes on it. So hopefully with these two examples, it now makes sense as to what return of capital is and how it can be good as long as it's not destructive through NAV erosion, as an example. So I'm going to cover the fund MSTY, which is one of the YieldMax's most notorious higher income ETFs, and they're actually paying weekly now. So if you look at the most recent distributions, you can see the return of capital being close to 100%. In fact, the payout on the 14th of August was over 98%. On August the 7th, it was over 97%. On the 31st, it was over 97%. So this is an example of a fund. And by the way, I made a video about it here on this channel. I recommend you take a look at it. That is what I would classify as destructive return of capital. Why? Because when you look at the net asset value, it's been eroding over time. And even taking a look at the distributions that they've done, they're not only erratic, but generally the theme is that they're going down as the weeks go by. So this is a fund that I personally talked about because I saw a lot of hype around it because of its high yield distribution. And now let's go into another fund that I think has more of the good return of capital. One fund that I would consider to have good ROC would be CHPY, which is also a YieldMax ETF. And the reason for that is if you look at its net asset value over time, it actually has not eroded when I looked at it. Yet you look at the distributions, which are also weekly, and the return of capital, even though it's 100% or greater than 90%, it's in a fund that is generally providing you with a return that is sustainable, in my opinion, and also it's not eroding, unlike MSTY as an example. One thing I wanted to do for you as well is show you how you can find the return of capital for your particular fund you're invested in. I'm going to take a specific example, looking at Neo's SPYI. So as I go through the actual distribution history, you want to look for a form called 19A-1. It can be called a notice, can be called tax information or distribution tax character. For this particular fund, it's called 19A-1. And what you want to do is you want to click on it. And specifically, I'm going to click on the very first notice simply for illustration purposes, which is 19A-1 notice for January 26. And you're going to see a document similar to this. Now, the actual format of view, again, is going to vary fund family by fund family, but the concept is actually very similar anywhere you go. And you want to take a look at the estimated return of capital. So in this case right here, it's 97% for this particular month. And there was an investment income of 3%. And that's how you can estimate your running tally, if you will, of ROC. And again, you want to focus on ETFs that have very little or no NAV erosion, because if there's a high level of NAV erosion, that's something that is going to jeopardize the dividends you have, and that's what's called destructive return of capital. You want good return of capital. And on that note, I did make a video talking about how to actually determine whether your fund has NAV erosion or no NAV erosion. There's actually a pretty simple formula, and I talk about it on this video here. Take a look at it. Thanks so much for watching. I'll see you on the next episode. Have a prosperous rest of your week.